Hello, traders. Gary Wagner here. 11:15 in Honolulu, 4:15 in New York on Thursday, January 27, 2022, and this is the daily report for gold and silver. A multiple meltdown in many asset classes was the net result of trading today. Equities scored deep declines. Cryptocurrencies declined along with the precious metals, with the exception of palladium. Gold gave up $34.90, with the February contract currently fixed at $1,795. The next most prominent active futures contract, which will come into play soon, is April, which is currently fixed at $1796.90 after factoring in today's almost 2% decline of $35.20. Silver had the largest percentage drawdown today, 1.057%, with the March contract currently fixed at $22.75. Palladium was the only precious metal out of the four precious metals traded on the futures exchange to avoid a sell-off, gaining $24.90, with the most active contract fixed at $2,375.50. The dollar was responsible, providing strong headwinds against the precious metals. You can see by the Kitco Gold Index, which I have just put on the screen, the effect that it has. Basis spot gold, which closed down $23.80 and is currently fixed at $1,795.60. The dollar accounted for $14.20 of today's sell-off, with selling pressure contributing $9.60. In the case of silver, dollar strength resulted in 18 cents of today's decline, with the vast majority, 62%, directly attributable to selling pressure. This first chart is a 5-minute candlestick chart looking at the highs in overnight trading day before yesterday, prior to the Federal Reserve concluding the FOMC meeting, and today's release of fourth quarter GDP. What we can see is a methodical drop of about $58 when we consider that gold was trading at approximately $1,848, and over the course of 2 trading days meandered lower to the tune of about $58 by the time it closed in trading today. On today's show, there's 2 basic questions that I want to ask and attempt to answer. The first one, has the move over the last 2 days caused any major chart damage? And if it has, where can we look to find support? As to whether or not gold has sustained any technical chart damage based upon the action of the last 2 trading days, I want to answer that by looking at 2 different techniques. The first technique is simply involved using a short-term trend line, and to do that, we are picking the most recent lows prior to today's decline, and what we can see quite easily is that we definitively broke below that trend line. The second technique we want to use is analysis of moving average. I have put up the 50 and 200-day simple moving average. We have 2 basic questions to ask: the relationship to those moving averages to current pricing, as well as the relationship of the 50-day to the 200-day. The first thing that we have to say is that we have our 50-day above the 200-day. The 50-day is a dashed green line, and the 200-day is a solid red line. We absolutely broke below that particular price point, and that would indicate chart damage. The second and most alarming thing is the fact that it appears as though the 50-day is imminently about to cross the longer 200-day, and that forms a death cross in terms of the technical terminology to define when the shorter-term 50-day moving average crosses below the 200-day. Combined, the trendline analysis, along with the analysis of moving averages, answers the following question, saying that the last 2 trading days have resulted in chart damage. The next question that we want to look at is, now that we have some confirmation that there was at least chart damage, maybe major chart damage, let's ascertain where we could look for potential support in the market. To that end, we are going to use the two different data sets, the longer term data set, which begins when gold was trading at 1920, down to the lows in the middle of August at 1678. The second data set uses a much shorter length in terms of data, from 1880 down to about 1758. And in conjunction with important Fibonacci numbers, we want to look for tops or bottoms at those particular price points to see if there's any historical data that gives relevance or importance to that price point. With gold currently trading at $1,795, the first target that we want to look at is the 78% retracement from the shorter data set, and then look back historically at that price point to ascertain whether or not we see a point in time in which it acted as support or resistance. To some degree, we can say through the end of December, it absolutely was a level of support. To some degree, a level of resistance back in November and December. And other than that, it doesn't really show us any major price point. The next level below that, of course, is 1770. And when we look back historically, to a minor extent, we can see that it was somewhat a supportive level, but certainly not nearly as strong as the 78% retracement at 1785. When we look at the 1758, which is the starting point based on the series of lows, we can see that that is a strong point of support. So if this market does in fact want to track lower, we want to pay close attention to the first level coming up, which is the 78% retracement at 1785, because it does have a period of time in which it acted as resistance as well as support in recent history. If it does by chance break through 1758, which I believe is not that probable, I would have to look at 1770, because in that particular price point, we do have a series in time in which it has acted as support, as well as an area of resistance back in September through October of last year. Unfortunately, for those that trade silver, we were stopped out. Our stop was just at the 50-day moving average, and undoubtedly, price action took silver far below that price point. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.